Hi guys, welcome back to my channel. Yesterday I put out a video where I talked about my overall portfolio performance compared to the S&P 500. And today I'm going to show you how to calculate your returns just like how the mutual funds do it. I think this video is one of a kind because I've scoured YouTube and I didn't see a single person talk about the correct way and the best way to calculate your stock market returns. So here we go. So for most people, when you want to go figure out how to calculate your returns on your portfolio, you would follow the most standard formula, where you take the ending balance of your portfolio divided by your starting balance, subtract 1, and that's how you get your percent return. But let me show you why there's a flaw with just applying the simple methodology. So let's take a quick example. Let's say you started off with $10,000 in your portfolio and you increase this portfolio to $12,000. And based on that simple formula, you would have a return on your portfolio of 20%. Let's say at that point in time, you came up with another $5,000 and you decided to invest another $5,000 for a total investment of $15,000. At that point, since you had already made $2,000, your balance at that point in time would be $17,000. So most people would calculate their return to be 13%. Now, that doesn't really make any sense, right? You invested your first $10,000, you made 20% on your money, and just by the mere fact of you depositing more money, this actually decreases your return on your portfolio. So let's take a look at another example where you invested $10,000. Now your balance is $8,000, so you had already lost 20% on your portfolio. And at that point in time, you did the same thing. You decided to add $5,000 to your portfolio for a total investment of $15,000, and your total balance at that point in time would be $13,000. So in this scenario, by the mere fact of you depositing another $5,000, your return got better. It went from negative 20% to negative 13%. Now that does not make any sense either. And mutual funds, when they get deposits and withdrawals through all their different customers, they can't reflect their portfolio that way. If they did that, their percentage that they're reflecting as returns would be completely skewed by money coming in and money coming out. So there's another approach that all mutual funds follow. So let me show you how that works. So this spreadsheet here I'm showing you is similar to how mutual funds would calculate their returns. I actually have an identical spreadsheet like this that I've kept for multiple years that helps me accurately calculate how I'm actually doing with my investments and not just based on deposits that I'm making into my portfolio. So the easiest way to do this is to have a starting point. Whatever date it is that you want to start calculating your returns, put in the date here. And this column, what I usually do for market value as a starting point is I add up all my accounts from my investment accounts, my option accounts, my 529s, my 401ks. I add everything into this count and I get a starting balance or market value in this cell right here. The next two cells are essentially formulas, so you don't have to worry about it too much. But for a starting purpose, I would keep the first cell as 100. And this formula here, and the next cell here is your dollars per unit. So because I had $10,000 in my example here, I had 100 units, I have $100 per unit, okay? So similar to my previous example, let's say on January 20th, my balance now is $12,000. You can see that I still have my initial 100 units, and now my dollar per unit, because it's 12,000 divided by 100, is $120 per unit. So if I want to calculate my returns at this point in time, I would take any balance, which is 120, divided by 100, which is my starting balance, subtract 1. So at this point in time, I would show a 20% gain, right? Just like how you would expect. So the key is you want to calculate your unit price literally the day before you deposit money. So the day before you deposit money, you want to calculate what your unit price is. So in this case, let's assume that I'm going to deposit money on January 21st. So I need to make sure that I calculate a per unit cost the day before, which is January 20th. And I still have a per unit cost of 120. So on January 21st, let's say I still have $12,000 at the beginning of the day, which is 120 per unit. I am going to add $5,000 of cash, which you'll see here. And this column here, which talks about additional units, also ends up being a formula. So essentially, if I am depositing $5,000, I want to take $5,000 divided by the current unit price at that time. So I would be essentially buying 42 more units, okay? So that means that my unit price starts off at 142. So let's say that my balance, nothing happened to my balance. Now I have $17,000 because I had $12,000 in my portfolio. I added 5,000 and now I'm 17,000. So you can see that by adding $5,000, I still have a per unit cost of 120. So if I calculate my returns on January 31st, I would take any balance, 120, divided by beginning balance, 100, subtract 1. So I would still be at a 20% gain, even though I added money. Okay, let's say a month later, now my balance, which had 17,000, has now grown to 20,000. I would see that now my new per unit cost is 141.18. So I take the ending balance of 141 divided by 100 minus 1, and my portfolio should reflect a 41% gain based on my abilities to invest successfully. Now, if we did it the regular way, where we had the initial 10,000, we added 5,000 for a total of 15,000. So if we did it the old-fashioned way, where we put in 10,000, we added 5,000, now we have 15,000 invested, and our current balance now is 20,000. Then we would only show a return of 33%. So when you do really well in your investments, which should reflect 41%, by adding all this money, it's actually lowering your returns, which is not very accurate. So this is a spreadsheet here that I've built up over time. I've continued to update this number basically once a month, just so I can see what my returns are for the month. And then when there are situations where I add money, I also make sure that I update the spreadsheet so I calculate the proper per unit cost. And then I could properly calculate my returns. So this is a little bit complicated, but I'm gonna leave this video up for you guys to kind of look at it and study it. And if you have any questions, just reach out to me and I'm happy to answer any questions that you guys have. Okay? See you guys in the next video.